Okay, good morning, everyone. I'd like to welcome you all to the Daily Energy Markets podcast. It's Monday, October the 6th. I'm very happy to have with me this morning Janiv Shah, VP Oil Markets at Ryside Energy, and Omar Najia, derivatives trader at BB Energy. Hopefully, we'll be joined by Ali Riyami during the next half an hour. Omar, let me go to you first and get a sense from you as to where we're now officially in the fourth quarter, the start of the fourth quarter. Trajectory for oil prices as you see it from the signals you're getting, macro and otherwise in the market.
Higher, higher, basically. You can, it's like, it's like that cork thing. You can try pushing the cork down. So last week we had Bloomberg or Reuters coming out and saying OPEC are going to increase by 500,000 or whatever it is. You have all these stories talking about tsunami of oil, flood of oil, I don't know what of oil, all this kind of stuff. And the oil price set a low back in May, $55 on WTI, and it's trading about $61 now. So I don't think that $55 is going to give way simply because of the way macro is. So if you think, everything in terms of macro is inflationary, if dollar is weak, gold is up, Bitcoin is up, equities are up. And now you have another problem in terms of AI, right? So AI is supposedly this thing that's going to come along and lead to kind of a moderation of these inflationary forces because it's deflationary. Because, everybody's job gets replaced with AI and you don't need so many people. So that's deflationary. So that will basically temper that inflation. But now the problem with AI is it's not going very far. We've had AI and it's more AI and people are investing in AI. But the next jump from AI to AGI is just not happening, or it's not happening as quickly as people forecast. Which means what? Which means basically that there is no moderation of that inflationary kind of thing, which means everything accelerates to the upside, dollar accelerates to the downside, and we get more inflation. So the risk is not we get deflationary forces coming into the macro kind of universe, but we get more inflationary forces heating up even more if this failure of AI kind of, doesn't change in the next year or so.
Okay, upside then, direction, Janiv, would you, agree with Omar there? Obviously, on the back of not surprising news, but we had, OPEC plus announcing their next sort of incremental increase in November as they did for October. But again, more supply hitting the market, hitting a market that no matter what Omar says about inflation, macro indicators are beginning, people say, to show in US consumer spending, et cetera, et cetera. Would you agree that we're up? And if we are still trajectorying up, but how fast do you think that is? And what is our sort of ceiling, if you like, for the year?
Firstly, good morning. Thank you all for being on this, and fantastic last week with the whole Gulf Intelligence and G Markets for It's fantastic job. Continued there. I think to begin with, I would like to say that yes, we typically agree with Omar that there is of course a supply glut coming. But our view here at the firm is that prices only have downside potential from here. And a few reasons why. So if you look at sort of Brent, typically made up of the fundamentals part or portion of it, and then of course the added geopolitical risk premium, which has been of course rife for the last, let's say, 3 or 4 years. And within the fundamental system, that is a huge loosening, right? So you have a quarter-on-quarter demand decline with seasonal patterns, which is of course putting a little bit of pressure on cracks and margins, which is a back pressure on the crude purchasing side of things. So there's a little bit less of crude demand happening, quarter on quarter. Of course, refinery maintenance is another key element there. But then moving over to the supply side, the quarter on quarter is not flat. It's not reducing in line with what the demand is, but it's actually increasing, right? Our growth there, quarter on quarter, I believe, from a crude balance perspective, is more than 2 million barrels a day. And that is, of course, going to increase now just ever so slightly a touch with this flow. Yesterday's OPEC Plus unwinding of, a modest, let's say modest or undervalued 137,000 barrels a day. Right? The market was expecting a little bit more, and you saw that within the backwardation, etc. But, for all intents and purposes, the fundamentals portion of the Brent delivery is likely to decline with the oversupply. But so to keep things, or to keep Brent supported, or even in any other benchmark, we're likely to see, or potentially to see, higher geopolitical risk premiums, which of course are, in the balance. Every day is a moving, evolving situation. But if we keep that flat, we're looking at Brent declining maybe $2 or $3 going into from Q4 into Q1 next year, and maybe even something similar from Q3 actually this year, coming into Q4 where we're sat right now.
Okay, I mean, Omar, geopolitical risk premium, if anything, though, we've had a few headlines. I know headlines are only headlines and the reality on the ground is very different. But that geopolitical risk premium, at least for the Gulf, Middle East, the whole Iran issue, etc., and now we have the Gaza headlines coming out. They've been called as definitely giving support to the current price, right, $3-4. But will headlines move that either way going forward? we're going to have a Gaza peace deal in the next 2 weeks. Does the market care about those headlines one way or another, Omar? You're on mute.
So basically, I don't think there's any kind of premium built into the market for, what's happening in Gaza, right? I mean, it's not affecting oil flows, right? It's not affecting pretty much anything. So, when you talk about Ukraine, maybe you can talk about, premium for oil, basically, but Gaza is absolutely zero. So all the stuff about, geopolitics in terms of we're going to have a peace deal, that's a no for us. I think, the much bigger question is a likely war with Iran. And I personally, I'm not I don't like counting as a form of analysis. I think basically this stuff went out in the, Industrial Revolution, right? Where basically I've got 4 bales of cotton to sell and I can sell them to 3 people, and therefore demand is 3 and supply is 4. And you use that to say that, and unfortunately, the oil industry for many years now is continuing this thing. So what they do is they get a line and then they iterate. So they draw like a line and then they draw dot, dot, dot straight. And then they say plus 10%, minus 10%. And then so everybody has the same numbers. It's not like anybody has any different numbers.
No, the forecast.
The only thing, the forecast is all exactly the same, except that some is like I'm minus 2% and I'm plus 2.7%. And this is going to be, I don't know what, I mean, honestly, if people, I mean, I just find that, it's a difficult job to trade, but trading on basically numbers that are so opaque and so they're not about today. They may be about a month ago or 2 months ago or when you had data and all this kind of stuff, right? Reality is markets are moved by flows of money. And flows of money and the macro situation and the sentiment and all this kind of stuff. So the point basically that I'm trying to get across is that oil is extremely cheap. And if you want to look at it, not in terms of what's going to happen today or tomorrow, if you want a position for making money in the oil market, I don't think I want a position to be short. Now, let's assume basically.
And what about, Omar, the speed of the long position, if you like? I mean, if you're saying we are on an upward trajectory, again, what factors are going to influence how far and how fast we go up?
So basically, you've got a lot of stuff. You've got basically anything to do with Iran. What's going to happen in terms of the global economy? Are we going to have, inflation kind of, increasing even more than it is now? What's going to happen to the European economy? All this kind of stuff. So in general, I don't see the world as coming together for peace and kumbaya kind of meetings by the fireplace. We kind of look at it as the other thing, right? So everything is more dangerous. Everything is more fractured. The war in Ukraine, we think, is going to get worse. We don't think it's going to get better. So you're going to see basically refineries getting hit, stuff blowing up, a danger to escalate even more. Sanctions coming against Russia, saying you can't buy any, blah, 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 all to the upside. Iran could be a massive war, shuts the Strait of Hormuz, $300 blah, blah, blah. So all I'm saying basically is what's the risk on the other side? What is it? That basically we've got 4 buyers and 3 sellers and all this kind of stuff.
Yeah,
and
I
that we're
suppose
going to
a lot of people are looking
buy a
at
couple of
the
dollars.
potential of economic recession and how that, obviously that has a
There
bearing
is-
on demand, on actual fundamental demand. Okay, Omar, I'll come back to you. Genevieve, I mean, on the Russia point that Omar made, Russia, we have had some damage to Russian refineries, and there's headlines on our bulletin today about gas oil exports, etc. For getting a bit more into the nitty-gritty of Russian refined exports, for example, are we seeing, from your perspective, any impact there on immediate sort of market outlooks for those products, and indeed the sentiment that we're going to see some more disruption to Russian flows?
Completely agree with you, Dilla. First off, I'd like to touch on a word that Omar mentioned, fractured, right? Of course, fractured is a key word going into the last couple of years, and even ever so much more now with the amount of, supply chain issues, logistical issues, but increasing trade flow, which is adding to inflationary pressures, etc., from a shipping standpoint. Coming into the Russia discussion, I think, over the weekend, Kirishi refinery was attacked, and I just heard a quick note, maybe confirmed or not confirmed, but Tuapse refinery has also been, hit by a drone strike. So increasing disruption is, yes, of course, going to continue is the projection. In terms of Russian refinery runs, there's only downside potential from here. Typical highs or typical averages of Russian runs of 5.5, maybe 5.6 million barrels a day have obviously come down. We saw 4.9 through the middle part of September. But, we can only look at this and look at the market from the existing flows, right? What is the latest flow? What are loading rates? What are unloading rates? And where are destinations being signaled by vessels and tankers? And from a product export angle, specifically diesel and gas oil, there is, of course, a limit going to come, of course, with the ban and the potential extension of this ban for pretty much all middle distillates coming out of Russia, such that domestic prices can be shored up from a safety security angle for the individuals on the ground. But, moving forward, as more drone strikes do continue, as they venture further into the Russian territory away from the Russia-Ukrainian border, and more export-focused refineries are attacked, yes, there's of course going to be larger disruption to the market. Now, coming into the impact of what that means there, yes, we're coming into the demand decline, the demand decrease quarter of the year, which of course puts a little bit of a tempered or muted dynamic on the price. But nonetheless, this fractured system and the fractured element of flows is likely to continue. And, the only ones who are going to suffer from this are typically the European market, because this is the time of the year where stocks start to rise back up after summer demand. And of course, if there's no availability or reduced availability of these molecules in the market, Europe has to compete with other parts. And as Omar mentioned, 4 bits of cotton and 3 buyers. There are a few more buyers for fewer suppliers.
Yeah. Omar, I mean, another bulletin we have on the news bulletin today is, again, this continuous headline of US debt, $37 trillion. Trump thinking that he can, I suppose, inflate his way out of that debt. Big investment bankers doubting his strategy. We've also got in the backdrop of that, a government shutdown on the political front in the US. I mean, more and more of the same, as you said. It's sort of blah blah blah. But is that situation of US debt, are the headlines around it, again, Democrat, Republican impasse, impacting sentiment, impacting macro sentiment? Does that help you bring down inflation a little bit? I mean, what impact is that politics having on macro sentiment, do you think? We've seen gold on the other side also go up to 3.8, 3.9. I mean, everything else keeps rising.
Everything else is going to keep on rising.
Hedging.
So basically, if you look at the shutdown, the only way they come out of shutdown is if they both agree to spend more to increase the debt, right? That's the only way they come out.
Yeah.
And they're going to come out of that, and they will agree to spend more, right? So it doesn't take like the US banking community to doubt and to say, the US has a debt of 37 trillion. It's running a budget deficit of 7%. And the economy is growing, if you're generous, by 3%. So if you're basically your deficit is 7% of GDP and you're growing 3%, you have a 37 trillion debt. It doesn't take a genius to understand that, you know, your debt to GDP, which is 120%, is going to get worse. I mean, it does not take a genius. It's like looking at something, you know, if it looks like a duck and quacks like a duck, and you know,
and yet it
and it's
doesn't
hanging in a
impact, it's not
Chinese restaurant
impacting
window.
functionality of the economy. It's not impacting. I mean, if it hasn't already, I mean, this debt situation is not new, right? So I guess it's getting.
No, but basically where it's impacting the economy is that you've seen the dollar fall 11 point something% this year alone, right? So basically and I think basically what you're seeing is the Fed, being forced to cut interest rates into CPI, which is at 3%, right? So inflation's at 3%, and what they plan to do is cut in 2026 another 0.75%, another 0.5%, and cut another 1 point something% in 2026. So they're cutting as inflation increases. The only reason you do that is because you need to lower the amount of money you're paying for your debt in terms of interest. That's it. It's called fiscal dominance. So basically, the US is entering fiscal dominance. They can't help it, and it's going to get worse. And everything they do with the stable coins and the BBB and all this kind of stuff is just going to make the situation worse and worse. So basically, what does anybody do with money if you have dollars? It's the dollars is the best fiat out of all of them, right? So basically, because why? Because it's a reserve currency and they can print as much as they want. The EU and the Bank of England and the Japanese yen, they're quite a little bit different. So if you have all these dollars, what do you do with them? You're worried that they'll debase. So basically, you buy anything. And what you need to buy basically is something called hard assets. And hard assets, why are they hard? Because it's difficult to make more, like gold, like Bitcoin, like property, be it land or a house or whatever it is. And people are also putting money into the stock market. They'll buy anything, even if the price to earnings ratio is 50. Yeah. So you value a company at 50 years forward earnings, and you just buy it. So it's not buying that's thinking. It's not buying that's saying, you know what, this and this and this, I calculate. No, it's basically get your money from the US dollar into something that's going to inflate with inflation. So it's very clear. So I think basically with all these things going higher and inflating, it's very difficult to see oil at a strategic level, at a trend level, not trending higher, especially with a geopolitical view.
Yeah, okay. Janiv, I mean, talking about oil supply again, just back to sort of the glut situation that you were sort of beginning to describe, and let's bring into that, the capacity of OPEC and OPEC plus, the spare capacity, because of course, yes, they're winding down these cuts, adding oil to the market all the time. There were, at the Energy Markets Forum that we held in Fujairah last week, as you mentioned, there was a lot of talk about spare capacity. Is that making the market nervous at all, that there is a lack of spare capacity, there's less spare capacity? Of course, you've got the non-OPEC producers as well who can bring on. But is that now, as OPEC winds down these cuts, is that actually becoming a bit of a supportive factor, do you think, in the background?
Somewhat, I'd say quietly. And of course, this is mostly an overlooked aspect of the oil market for the last few years because of the vast amounts of it, right? So the buffer system, or the buffer part of the oil market, has been so wide and large that is taken sort of in the shadows. Now, estimates of spare capacity range quite a fair amount, and we've seen, other individuals, other agencies putting some numbers out there. But our estimates are that there's still a fair amount of this spare capacity, but most of it is likely to be held within the UAE and within Saudi Arabia. Right, the rest of OPEC plus nations don't have a lot to offer in terms of how much material volume they can bring onto the market within the 30 or 90-day period and sustain it to those high levels. Now, if we consider that a lot of the spare capacity was built up with 2019, 2020 COVID peak, where supply had to be turned off at the taps almost instantly, such that the market balance didn't flip a different way, and Brent didn't fall all the way down into more negative numbers. But a lot of that material or volume in terms of assets has been shut for a very long time, which means bringing them back up, ramping them back up would require a little bit more effort or energy than maybe others in the market could have predicted. So yes, spare capacity is declining as OPEC Plus has, turned the taps back on from the middle part of this year with accelerated unwinding. And of course, now the 1.65 million barrels a day voluntary cut tranche has been, eaten into with 2 months of 137 KBD rises. But moving forward, yes, this is likely to be less of a buffer and more of more of a bullish, let's call it a bullish sentiment that the less that there is available, the higher prices could rise too. Nonetheless, saying something about OPEC Plus, we also have to discuss about China and Chinese stockpiling.
Yeah.
So Chinese stockpiling is not, it is not solely for commercial use, right? It's more from a strategic angle, strategic point of view, which puts a bit of a bullish signal into the market as opposed to, the bearish side. If, for example, say the US SPR was being stocked or US commercial inventories. Now, saying that, we do see or do forecast some slowing down in Chinese stockpiling for next year for a few reasons, but the elements of that have really supported and kept Brent, a floor of Brent at around $60 is what we're seeing. So yeah, much to be seen. Now coming up to the non-OPEC side, increases in supply, let's say from the US, with typical decline curves, asset levels, but also where these, what the types of quality of these barrels are only going to provide a little bit of upside thereafter because, investment levels, the, number of DUCs that are available, but also the rising number of dead DUCs. So drilled uncompleted wells, which are not able, in our assessment, are not able to come online very quickly or rapidly, but are only there from a financial standpoint for the operators are rising. So, a little bit more tightness, we'd say, in the market. And going into next year, yes, a bit more bearish picture because of, we're coming into next year with higher stock levels, potentially, and reduced demand year on year. So reduced balances. And so I think that's where I would answer that.
And perhaps the Chinese stockpiling will also slow down. But of course, the advantage there is that the dollar is weak and Brent prices and oil prices are relatively weak for China, so no wonder it has been doing that. There's our survey question: what will be the main effect of the OPEC Plus output hike, the recent one that they announced just this weekend for November? Will it mean that we'll have stable prices? You could argue prices have been more or less stable already in the last few weeks. Lower? Will it encourage non-OPEC output or weaken OPEC Plus price control, maybe because of the spare capacity lever, perhaps that may be slightly diminished. Omar, let's talk a bit about gas and LNG. We at our forum last week also, there was a lot of talk about the immediacy of a 2-year glut in LNG, but of course long-term perhaps different. But let's look more immediately. I know it's not a market that you follow specifically, but as we head into winter as well, in gas price sentiment, are you equally sort of upward trajectory bullish? Will that follow oil? I mean, what are the factors influencing that?
Okay, so the one market that I follow is Henry Hub, which is the US kind of gas, right? So that's trading at 3.3 something, right? That is going to absolutely fly, and it beggars belief.
When is it going to fly?
Now we're going into winter, right?
Yeah.
So winter, basically, people are always shocked and. Yes, I thought it was going to fall. Who knew it was going to be cold? I mean, it's really colder than it was, and it's super. I mean, Jesus, so basically, who in their right mind is going to come and say, you know what, we're coming into winter. I have a great idea. Well, imagine talking to people here, like, come guys.
Take us back last winter. What was the highlight?
We're gonna. I have no idea what happened last winter. So basically, going forwards. I think if you put people together, traders, and you say to them, I have a fucking amazing idea. Let's go short just before winter, because nobody else is going to think of that. You'd have to have a hole in the head. Why would you go short? What are you betting on? A warm winter? A warmer than anticipated winter? Winter is the time to go long, right? You go long heating oil, you go long gas. Summer is the time to go long gasoline, right? That's why they're called seasonal products. And basically during hurricane season, you also want to go long. Now, is it possible that you don't get a hurricane? Absolutely. But you don't want to be short going into hurricane season. You don't want to be short gasoline going into the summer. And you certainly don't want to be short distillates and gas going into the winter. I mean, you need that like a hole in the head. So I find it extraordinary that people would be thinking like, let's it's going to come off because it's winter, all this kind of stuff. No. So we like, we're
Upward trajectory.
Upward trajectory in Henry Hub. We're going to go higher. The world, we used to have these discussions where people used to say, you know what, solar is going to come and displace and all this kind of stuff. And so then it's going to be wind. Then it's going to be kind of, compost. They're going to liquefy it, turn it into, and all these things have died away, right? So the world is moving. What the world needs is cheap, especially going forwards if the macro picture is right and everything skyrockets. People need cheap energy, right? They don't care if it's green or blue or purple or whatever. What they want is cheap. I mean, how do we know? Ask the Europeans. The Europeans now are paying so much for gas, they're down the toilet and forever. So basically, people need cheap energy. The cheapest energy in the world is called Henry Hub piped gas from anywhere, be it from Russia, be it from the US, be it anything. Yeah. Piped gas is cheaper than LNG, cheaper than oil, cheaper than anything. So how you can be bearish something like piped gas is beyond me.
Yeah,
so
I mean, LNG, obviously, Jeanive, there is obviously a lot of supply in the pipeline, if you like, for the next 5 years out of different sort of locations. But there's, and the LNG market has been extremely volatile the last few years. Jeanive, let's talk a bit about, again, back to demand support. We mentioned China earlier, stockpiling. What about India and its intake of Russian gas? Again, we had a few comments on that last week at the forum. You've got that question there that's just been put up by the team. What will have the biggest impact? Geopolitics, that was quite surprising. But we discussed all those factors this morning. But let's talk a bit about Indian demand. I mean, Russian intake of oil, it was up to 30% of India's intake. Do you see any indicators there in the market that will continue or not going forward, given the trade pressures and negotiations that are also happening with the US on that?
Great question. I think some potential downside, but I'll say some, and I'll also say potential within that answer, because the Indian market works in a completely different way, as we spoke about extensively during one of the lunches in Fujairah. But nonetheless, the cheapest market source of energy or oil is likely to be taken, right? So India remains to be a very, let's say, strong friendship or alliance with every country, such that it can pull from and take any type of energy from a cheapest perspective. Because for the Indian market, it's very much economically driven, right? So the highest margins possible, and of course, implementing or impacting various markets and targeting those export markets. So do we see potential, let's say, disruptions to Indian flows in terms of the sources of? Pretty unlikely, but of course, if sanctions do hit further and tariffs, and you've seen secondary sanctions being announced on any Indian, diesel coming into Europe, for example, that is likely to put a little bit of pressure.
Negotiations, I guess, from the US. What about, sorry to interrupt you, what about Iranian oil? Have you continued to sort of see that in the same volumes in the last few months? Anything has changed since June, since July?
Well, Iranian oil is one of the key reasons why we have Chinese landed cost of crude being so depressed, right? And so competitive compared to the rest of the markets, because sanctioned and it's at a cheaper rate. So we haven't seen a reduction in flows, and instead, any potential excess has been snapped up by, via Malaysia, but going into the Chinese storage. And of course, let's mention back on Chinese storage, a lot of this is new capacity and still being built this year and next, and very cavern based, right? So real raw levels of how much is within the system is somewhat masked nonetheless.
Okay, Omar, let's go to you just to close. I mean, the team had brought up some projections for prices next year. Again, back to the oil price, we upward trajectory as we go forward. But a lot of our panelists last week at the forum saying that the average price next year they expect will still remain between 65 and 70, which of course is what it's been the last few weeks. We started the year higher. You're saying upward trajectory next year, but could we be capped at $70, do you think, for 2026 still?
Yeah,
we're not going down, but we're not really going much further up.
Well, I mean, everything is possible. It's all about probabilities. So basically, if you ask an ostrich, sticks its head in the sand and tells you, like, you know, if it's being attacked by a lion or a big game hunter's coming at it with a big shotgun, sticks the head in the sand and tells you everything is the same as it's always been, and we haven't been above here, we haven't been below here, so everything is the same and you don't need to worry. So no, I don't think that that's the most likely scenario that we're going to see for 2026. So there's two scenarios. One, so let's assume basically that the macro picture is right. Let's assume that all the money invested in equity indices, all the money invested in currency, in DXY, all the money invested in gold and Bitcoin. So, you know, quite a few, maybe like 100 trillion, if not more, $200 trillion. All that money basically is, let's assume, is right? So
Okay.
oil has two options. One, it goes up along with them, starts a new trend to the upside, etc., breaks 70, 80, 90, 100, whatever over time. That's option one. Option two, oil basically says to itself, even though everything is going higher, everything is booming, the spending on the economy is increasing, factories are ramping up production, production of chemical whatever is going up, all this kind of stuff. People are flying, blah, 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 heating homes, all this kind of stuff. But oil is going to be the only thing that basically decides it's going to do nothing or head lower. So if you believe in that, then you should definitely be selling. And if you think that that's very unlikely, like I do, you should be basically buying it. So I'm not looking for oil not to move, and I'm not looking for oil to go lower. I'm looking for oil to start a new massive uptrend over time with commodities in general up and to the right in a big way, right? In terms of a strategy and a vision, all this kind of stuff. What I don't expect is sideways motion or lower over time. The question is timing, when do you position, how big, is it today, is it tomorrow, has it started, you know, is the low in for the year, blah, 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 blah. And I think basically that a lot of people, this is another very interesting thing, another reason why I think you're not going to see that is a lot of people see that and want to get long, which means that every time oil is trying to go lower, it's not being able to, because everybody wants it to go lower, because everybody wants to buy it. Same with gold, same with Bitcoin, same with the S&P, same with Nvidia, everybody wants to buy it. So it's not going to come off.
Okay, thank you, Alper Al-Marnajia, and thanks to Yaniv Shah as well for joining us and getting us started this morning on the first podcast of October, beginning of the fourth quarter. Let's see where we go from here. Thanks everyone else for joining us as well. Have a great day.
Thank you.
Bye-bye.
Thank you.
Thank you.
Bye.
Bye.